In this episode, we are going to talk about optimal trade entry, which is also known as OTE. I will explain how to identify the correct swing points to use OTE and how to identify if it is going to fail. So let's get into it. Now, before getting into this concept, it is very important that you already understand discount and premium. If you do not understand those concepts, then this topic will not make much sense. The first thing we are going to do is go through a PDF explanation. Inside the PDF, we will look at the Fibonacci settings, along with a few examples. After that, we will jump back into the charts and find some real chart examples. So let's start with the Fibonacci settings. For these settings, I will be using the levels 0.5, 0.62, 0.705, and 0.79, along with the standard 0 and 1 levels. These are the levels I input into the Fibonacci retracement tool. When the tool is set up correctly, it will look something like this. You will have 0 and 1 marking the full range, the 0.5 level representing equilibrium, and the zone between 0.62 and 0.79, which is known as the optimal trade entry zone, or simply the OTE zone. The 0.705 level acts as the midpoint of that optimal entry zone. If you look at the settings in TradingView, the Fibonacci retracement tool will show something very similar to this layout once those values are added. Now that we understand the Fibonacci settings, the next question becomes, how do we actually use the Fibonacci retracement tool? What I do is very simple. I look for a swing high and a swing low. If you do not know what a swing high or swing low is, I recommend watching my liquidity video where I explain that concept in detail. Once I identify a swing high and a swing low, I simply drag the Fibonacci retracement from the swing high down to the swing low, or from the swing low up to the swing high depending on the scenario. Once I do that, the retracement levels automatically appear on the chart. Now let's jump into a chart example to see how this works. In the first example, we are looking at a bearish scenario, so we will draw the Fibonacci from the high to the low. After that, we will also look at a bullish example. If you notice here, we first get a swing high. Now we wait until a swing low forms. Once that swing low is formed, we can take the Fibonacci tool and drag it from the swing high down to the swing low. Now let's look at the bullish example. Here we first get a swing low, and now we wait for a swing high to form. As price continues moving up, we can keep adjusting the Fibonacci until the final swing high is established. Once that swing high is confirmed, that becomes our range, and the Fibonacci retracement is properly drawn. Now the important question is, how do we actually use this information? Once we have a swing high and swing low marked and our Fibonacci range drawn, what we are looking for is price retracing into the optimal trade entry zone, which is the area between 0.62 and 0.79, including the 0.705 midpoint. From this area, I begin looking for either an entry or a lower time frame entry model, with the expectation that price will continue lower and eventually reach sell-side liquidity resting below. Now let's go back to our examples and see how they actually played out. In the bearish example, we already marked out our OTE zone, which is the area between 0.62 and 0.79. This is the area where I ideally want to look for short entries. Now let's see what happens when price retraces back up into that area. Price retraces upward, taps the 0.705 midpoint, which is the middle of the OTE zone, and then price begins moving lower, eventually reaching the sell-side liquidity below. Now let's go back and take a look at the bullish example. In this case, after marking the OTE zone, what we ideally want to see is price moving upward out of this OTE area. If we look above price, we also have a fair value gap resting above, which gives us a logical target. And as you can see, price does exactly that. It moves out of the OTE zone and reaches the fair value gap above. The next important concept is aligning the OTE zone with other PD arrays. For example, when I draw the Fibonacci and identify my ideal short area inside the OTE, I always look to the left of the chart to see if there are any PD arrays lining up with that zone. In this example, what do we see? We can clearly see a fair value gap sitting inside the OTE area. Now we have multiple confluences. We have both an optimal trade entry zone and a fair value gap overlapping, which makes the setup stronger. Now let's go back to the charts and see if we can find additional PD arrays lining up with these examples. Looking again at the bearish example, I have already marked out the OTE zone, and when I look to the left of the chart, I notice something interesting. Yes, there is a fair value gap, but my attention is actually drawn to these up-close candles here. That gives me multiple confluences for the point of interest where I expect price to move lower. Now looking again at the bullish example, we have the OTE zone marked between 0.62 and 0.79. Are there any PD arrays that stand out? If you watched my latest video, you may notice that there is a large down-close candle that sweeps liquidity below, followed by displacement, and a close above that candle. That validates the candle as an order block. However, when we look at the opening price of that order block, we notice something important. It is not exactly inside the OTE zone. In situations like this, I will often use the mean threshold of the order block, which is the 50% level of the candle body, instead of the open price. Now this gives me another confluence within the OTE area. There are also many other ways traders could interpret this. For example, some people may notice the volume imbalance nearby, which was also respected. But personally, I focus on the PD arrays that stand out the most, and in this case that would be the large down-close candle and its mean threshold. The final concept I want to discuss is what happens after price moves out of the OTE zone. Once price moves out of the OTE and forms a new swing low, we now have a completely new range. When that happens, we can mark out that new range and use the OTE concept again. And this becomes even clearer when we start applying it on lower time frames, which we will now look at directly on the charts. So, in this example, we are going to take a look at Euro USD, starting from the daily chart and then dropping down to the hourly time frame to refine the analysis. First, on the daily chart, you can see that we have a clear displacement range. This is a strong impulsive move in the market, and whenever we see displacement like this, the natural expectation is that price may retraces back into an optimal trade entry zone before continuing in the direction of the move. So ideally, what I want to see is price retracing back up into the OTE area, which is between the 0.62 and 0.79 Fibonacci levels, before continuing lower. And if you watch the chart carefully, you can see that price does exactly that. Price retraces back up into the OTE zone on the daily time frame. Now, once we see that happening, the next step is to drop down to a lower time frame so we can analyze the internal structure of this move and potentially find more refined opportunities. So now we move down to the hourly chart. Here on the hourly chart, you can see the same displacement range that we marked on the daily time frame. Price retraces back into the OTE zone, and while doing so, it actually fills an hourly fair value gap. This gives us additional confluence because now we have two concepts overlapping: an optimal trade entry zone and a fair value gap. Now what I want to see next is whether price begins to displace lower from this area, because if it does, that will give us a new range that we can measure again. And if you look closely, you can see that we do begin to get displacement to the downside. So what I do here is identify the high that created the new low. That high becomes the top of my new range, and I will begin to track price from there. As price continues moving lower and creates a new low, I adjust the Fibonacci and extend the OTE zone downward to reflect the new range. Then something interesting happens again. Price retraces back up into the OTE zone once more, and from that area we get another displacement lower. If we follow that move, you can see that price takes out the previous low, continuing the bearish movement. After that, price begins to displace back upward again, which means we now have another new range forming. At this point, what I would like to see is price retracing back down into the current OTE zone again. Now, if you look carefully at this area right here, you can see that we also have a breaker block sitting inside this zone. So now we have multiple confluences overlapping again. We have the OTE zone, and we also have a breaker block. Now the question becomes, what happens when price returns to this area? If we watch the chart, we can see that price does come back down into that zone, and when it does, we get a very clean reaction. Price reacts nicely from the combination of the breaker block and the OTE zone, showing exactly how powerful it can be when multiple PD arrays align in the same area.
Now let's look at a top-down example of how I would actually use this in real trading. In this case, we are looking at gold on the hourly chart. The first thing I notice is that we have a clear displacement to the downside. Whenever I see displacement like this, the first thing I do is mark out the displacement range and start watching that range for a potential optimal trade entry, or OTE. After this move down, price creates a new low, so I adjust my Fibonacci retracement to reflect that new range. Once the range is updated, the next thing I do is look for PD arrays that line up with the OTE zone. When I look to the left of the chart, I notice something important. Inside this OTE zone, we also have a fair value gap. So now we have two confluences overlapping in the same area, the OTE zone and the fair value gap. Whenever I see that type of alignment, the next step is to drop down to a lower time frame to look for a more precise entry. So now we move down to the 5-minute chart. On the 5-minute chart, we wait to see if price retraces back up into that OTE area. Before price reaches the zone, something interesting happens. Price begins to form a series of equal lows, which means it is generating liquidity below the market. That liquidity can later become a target. Eventually, price moves back up into the OTE zone. But an important detail here is that it happens outside of my kill zone. Since I only like to trade during specific kill zones, I ignore that move and continue waiting. After that, we finally enter the kill zone, and price begins moving upward again. Price pushes up, reaches the 0.79 level of the OTE, and at the same time the candle bodies are still respecting the hourly fair value gap. From that area we then get displacement lower, confirming the reaction. Now on the 5-minute chart, that displacement creates a 5-minute fair value gap. That becomes a potential entry zone. To refine the entry further, I drop down again to the 1-minute chart. On the 1-minute time frame, I notice a full-bodied candle pushing back up into the 5-minute fair value gap, and then price immediately begins to displace downward again. That full-bodied candle effectively becomes an order block. So my plan would be to look for an entry around that order block area, place my stop loss above the high of that candle, and then target the lows that were formed earlier, which include the liquidity generated prior to the session, such as the London session lows. So the setup would look something like this: entry near the order block, stop above the high, and targets at the liquidity resting below. And as you can see, once the trade triggers, price moves lower and delivers the move into those liquidity targets.
All right, so that is how you can use the optimal trade entry, OTE, together with other PD arrays to build a strong trading setup. The main idea is to start with a top-down analysis, identify the displacement range, and then mark out your OTE zone using the Fibonacci retracement. After that, you look for additional PD arrays, such as fair value gaps, order blocks, or breaker blocks that align with that OTE zone. Once you have that confluence on the higher time frame, you simply drop down to the lower time frames and wait for price to reach that area during your kill zone, and then look for a lower time frame entry model. When you combine OTE, liquidity, and PD arrays, it gives you a much clearer narrative for where price is likely to move and where you should be looking for entries. If you found this video helpful, make sure you like the video, subscribe to the channel, and share it with someone who is trying to improve their understanding of ICT concepts and price action. And as always, I will see you in the next video.